Recording now. So we're doing page 21 in the course pack. So read the problem at the beginning. If it gives you opening balances and if it gives you T accounts, put it down on the T accounts, because that is going to help you solve the problem. Okay. And Helena, I'll get to that in just a sec. Okay, so then it's time to, so what happens? So normally the normal balance for allowance for doubtful accounts is a credit balance, because it's a reserve against an asset account. It's a reserve that says, hey, we have this asset, accounts receivable, that's $520,000. But against that, we have this reserve. And currently that reserve amount, it's a reserve for bad debt. So what we're saying is if we have a bad debt, we've already set aside some funds because we've anticipated this. And this journal entry here is how we do that. Okay, but because we're using the percent of AR method, we have to look at the beginning balance. Peter, go ahead.
I was wondering, is allowance for doubtful account, is that a contra asset or?
It is a contra asset. So what is the contra asset's normal balance? What's an asset's normal balance?
I don't know. I don't know how to answer that question.
So if I said we have cash, which is an asset, what's its normal balance? How do we increase the cash account, with a debit or a credit?
You debit it.
Okay, so all the assets normal balance are a debit, and that means that if you increase an asset, we debit it. But we also have these contra assets, and we learned about one in Accounting 201, and that was accumulated depreciation. Now we're learning our second contra asset, and it's allowance for doubtful accounts. So its normal balance is a credit. So we increase it by crediting it. Okay. But sometimes it goes into a debit balance. And that's why I'm saying you really need to be aware of that. So in this situation, it's a credit balance. And you go back up here and you're given all these percentages to apply to accounts receivable. So 34,000, 20,000, 87,000, 379,000, they all add up to the accounts receivable balance. But the more these accounts age, which is telling us that some of our customers are not paying on time, the higher the risk. And that is why we estimate bad debts. So we estimate them using these percentages, and different companies have different percentages. But we're going to use these for Jet City, which is this company. We're going to apply them to the outstanding balance, add them up, and we're saying, based on our research, we need 36,670 in that allowance account. And then we come down here and we say, look, we only have 17. Because we're using the percent of AR method, it needs to add up to our estimate. So we only need to increase that, we only need to put 19,670 into our journal entry because we already had 17 unused. And that's how you guys came up with this number. Okay. You also learned a percent of sales method. So turn the page to page 22. If I can find it, here we go. So let's go to page 22. Now, oh, I'm sorry, let me go back to Helen's question. If your beginning balance was let's go back to page 21. If your beginning balance was a debit balance, let's say it was a balance of 2,000, or let's make it 4,500, then your journal entry would be a lot bigger because you'd have to take into account the 4,500 in order to get to 36,000. It would be more like 40,000. Okay. And what does it mean when ADA has a debit balance? It means between the last time you estimated bad debts and this current time we're estimating bad debts, we've written off more than we thought we were going to write off. Okay. When it goes into a debit balance, we've written off more. Okay. All right. Let's.
For mom and dad.
All right. So let's go to page 22 in your course pack. All right.
Nice success or
All right. So we're on page 22 of the course pack. Now it looks very similar to page 21. So read it carefully. Don't read all the detail first. I tell students all the time, in a test situation, bring a highlighter or something and go straight to the directions or the instructions. Make the adjusting entry below. Use the percent of sales method. Okay, so what that means is you don't need to age anything for percent of sales. You just take a percent of sales. Okay. All right. All right. So let's go back into your breakout rooms for 4 minutes and see if you guys can give me the adjusting journal entry on page 22. Okay. All right.
Both ways.
JR, are you there? We're going into breakout rooms. JR, are you there?
Wait, what?
I'm just doing what I did on the last one. Hopefully I get the right answer.
Yeah,
I
let's,
got 42,220 for the total debt percentage.
let me see.
Yeah, I got the same thing.
You can do it by vote.
You said by both, like by either method?
No, I'm just kidding. Go ahead. You're doing percent of sales method only. What'd you get, Micah?
I got 42,220 just for the total debt percentage.
For the journal entry?
Yeah, I guess.
How'd you get it?
I just did, like multiplied the 454, 102, etc., and then added them up.
Oh, and you're doing percent of sales?
That's all I know how to do. I haven't like,
All you got, anybody have a different method?
Is
got
it
62,500.
62,500?
500, right? That's like,
you guys got 62,500.
we did not set you up. That's what I got.
And Helena, you got the same. And anybody else, Tegan or Otto, what'd you get?
I got the same thing as Micah.
62,500.
Otto, sorry, can't hear you.
I'm with Helena, 62,500.
Okay, I need you guys to explain how you got it. You are correct.
Multiplied 2,500,000 by 0.025.
Yep, and this is such a stinking easy way to do it. I'm not kidding you. And
You
most
said 62,500 was your answer.
correct.
Yes.
Okay, and why did you move the decimals on the 2.5%?
Because that's what 2.5% is.
Oh yeah, sorry, I'm
When you
stupid.
multiply.
No, you're not.
Never mind. So what, like, how come they're two different answers, like the two different methods? I don't get it.
There's only one answer. The question is, what question are we asking? If you're using percent of AR, you do that full aging. If you're doing percent of sales, you just take that percent and apply it to net credit sales, and you're done. It's very fast.
So
Okay.
if I went through the process for the other method with these new numbers, I would still end up with 62,500.
If you went through the process with these other numbers, you would be wasting your time.
But would it be the same answer? Like,
No, no, it's two different
So
methods,
then-
two different answers.
Yeah, I got a different answer.
So
so what do you do? Like what's the difference between the numbers then? Like in more of a, like what they actually represent?
So let's compare them. Well, I'm going to go back to the main room, but a company makes a decision as to which method they want to use. And they have to be
Oh,
consistent.
okay.
And so it's like LIFO versus FIFO. You're going to
Yeah,
get different
yeah.
answers, but you have to be consistent.
So
Okay?
you have to be consistent with what?
Whatever you're using, you can't
Okay,
flip-flop year to year. Although CEOs and presidents try to get you to do that. So, oh no.
Okay, that clears things up a lot. Thank you.
Hi, Ridwan. Ridwan, are you there? Right, we had some good questions last time. Okay, I was in one of the rooms and we had some great questions. Okay. But we'll wait till room 3 closes. There's everybody back? All right. Okay. All right, I'm going to share my screen. So let's go over the answers. So we're on page 22 of your course pack. All right. And we have. Hey, Peter. Peter, are you there?
Yeah.
Can you turn the sound off on your radio or whatever that is?
I didn't know the mic was on.
Oh, well, I'm hearing something. I thought it was you. Maybe it's somebody else. Okay. Your square lit up. Okay. So we're on page 22. On page 21, we were doing remember the allowance method where we have accounts receivable is one asset account. Allowance for doubtful accounts is a second asset account, but it is a contra asset. And it's to reduce the value of accounts receivable by the amount we think, the company thinks they're not going to collect. Okay. So they have to come up with an estimate method. And there's two choices. One of them is percent of accounts receivable. We did that on page 21. The other method is percent of net credit sales. And that's what we're doing on page 22. All right. So we said, okay, now we've got 620,000 in accounts receivable. I gave you the full aging, but this is why it's really important to read the directions first. Use the percent of sales method, which is shorthand for percent of net credit sales method. Okay. This method is so easy. All you have to do is take the net credit sales of 2,500,000 and multiply them by 2.5%, and you're done. So 2.5% of 2,500,000 is 62,500. You do not have to do the aging whatsoever. It's there kind of as a distraction. It's good to know how old I mean, you do have to do the aging because you want to see how old your accounts receivable is, but for the estimate, you don't need it. And so we don't need these percents. We don't need any of that because we're using the percent of sales method. Okay, so here's our journal entry for estimating bad debts. Be sure to write this in, and then here's how it looks down here. Now, I was in a breakout room just now, and the question came up, well, shouldn't they come up with the same answer as the previous page? No, this is like LIFO versus FIFO. You're using different methods. You just have to be consistent. You have to be consistent, and you have to have a reason for why you think 2.5% of your net credit sales are uncollectible. So the credit manager, the person in charge of accounts receivable, has to have a reason for why she's using 2.5%. And it looks like that's a little high because we didn't use all of our last year's balance, okay? You kind of want to be a little bit closer to, whatever. So the question is, you're not done when you do the math, the arithmetic. You always have to ask yourself, are my percents reflective of what's really happening? Because it's an estimate, but it has to be based on a rational explanation. Okay. So any more questions about that? So I'm gonna.
So it's 2.5% of 2.5 million.
Correct, of the net credit sales. Yeah.
Judith, how come you put 17,000 for allowance for doubtful accounts on the T account?
Oh, good question. Hang on, Tegan. All right. Anybody know why? You may or may not. Okay, it's because it is the beginning balance. The allowance for uncollectible accounts has a credit balance of 17,000. So the problem gives it to you. Okay, so I'm showing it as we were given this. This was our start. Accounts receivable has 620,000. Be sure to write that on your own course pack. Allowance for doubtful accounts has a beginning balance of 17,000. Did they give us any information about bad debts? Yes, bad debt beginning balance is 0. Okay, and that should have said bad debt expense. So you can write that word expense in there. Okay. All right, any other questions? Thank you for asking that. All right. Okay, let's move on. We started introducing credit card sales. So I want to cue that up. Okay. And I believe I told you guys that we spend, the typical customer spends more money if they use a credit card versus using cash. And so merchants have learned that even though they have to pay fees for the credit cards, it's worth it to them because typically their sales will be higher if they accept credit. Okay. All right. Make sure I am recording. Yes, I am recording. Okay. So let's talk about credit card sales and other factors. I should say just factors. Okay. So we talked about this briefly on Monday. Credit card sales come with a lot of fees. If you personally use a credit card, you don't see these fees. These are charged to the merchant and all the players in between. And so it's kind of a situation where you have to decide if you're willing to make a sale for $100 and only get $95 for it. Okay. And that's why, I don't know if you, well, of course you guys buy gas at the gas station, but sometimes you'll see a sign saying $3.99 and in tiny print, it'll say cash and then credit will be, $4.25 or something a little bit higher per gallon of gas. Okay. That's what the gas stations are saying. They want you to pay the difference. They'll give you a discount if you pay cash. I don't know if they're doing that so much with COVID because people are all wanting more credit cards. Okay. Okie doke. So who is the credit card issuer in this case? It is the Bank of America who's issuing it. So the merchant's actually protected from bad debts. So the merchant, the Jamba Juice or whoever it is that's accepting your credit card, they're not the issuer. The Bank of America is the issuer. And so they're taking all the risk. So if a customer can't pay their credit card bill, the Jamba Juice or Starbucks or whoever doesn't have to worry about it. Okay. Okay, so let's turn in your course packs to page what? Let's go. We have a lot of blank journal entry forms there. I had this idea that you would be using them in class, but we're using them here. You can use them for your own use later when you do homework, practice your homework. Okay, so we are on page what? We are on page. Nope. 26 in your course pack. All right. All right. All right, so we're gonna log this journal entry on page 26. So we have a lot of players here, and I would strongly encourage you to write this down in your course pack. So before we even start to demonstrate this problem, it's really important for all journal entries because they come in at you so randomly. It's not like you're in a company and you're doing journal entries for the same company all day long. You guys are getting problems with different names and different characters all the way through this class. So let's write down the players here. The local burger, Crate and Barrel, and US Bank. Who is who in this problem? Whose journal entry are we doing in this problem? Who is, I'm going to call it, who's the retailer? Who is the merchant here? Who's the company that we're doing? So go ahead and put it in the chat. Whose journal entry are we doing here? Rand, correct. No, Rand, you're not correct. Sorry.
I'd say Crate and Barrel.
Yeah. Oh, we got 2 votes for Crate and Barrel. 3, 4, 5. Yes. So the company is Crate and Barrel. And so I find a problem that starts out with a name. My bias is to assume that's the company. So I have to read these problems a couple times. And Helena, ask me that question in a few minutes after we do this, if you still have that question. And I think you probably still do. Okay. So the company is Crate and Barrel. So somewhere in your notes, right? Company, Crate and Barrel, it's just somewhere. Okay. Retailer, merchant, company is Crate and Barrel. Okay. All right. Now, who is the customer? Who is the customer?
Local burger.
Local burger. All right. So local burger is buying from Crate and Barrel. If you guys know those companies, well, you can guess what local burger is. It's a restaurant, and Crate and Barrel sells furniture and other stuff. Okay. So local burger bought furniture from Crate and Barrel. Local burger people used a credit card to buy $1,000 worth of furniture. They used their Visa, US Bank Visa, to do it. Okay. So then the question is, how does, and the US Bank, the issuer, charges 3% to Crate and Barrel. So what do you think the journal entry is going to be by Crate and Barrel to record this sale? So we started out this class with a quick review of how we book sales. Okay. What will be the entry to sales? Debit or credit? So
Would
how
sales
much?
be credit?
It will definitely be credited. How much? How much will sales be credited?
970
Because
you take a 3% service fee off.
that is a really good guess, and it's wrong. They actually get credit for the whole sale, $1,000. Okay, but we need that 970, Bryce, because we're going to debit cash $970, because that is what Crate and Barrel is going to see as cash. Okay, so let me show you the entry.
Can I try real quick?
Yeah,
I thought, are we using like the perpetual system where like get to do like cost of goods sold and inventory?
oh, that's a really good question. I'm not asking for the other half of its journal entry at this time, but you're right. If we did, we'd debit cost of goods sold and credit inventory along with this journal entry.
Okay.
Thanks.
So
I
we count it as cash and not accounts receivable.
I know, isn't that weird? Sales, I'm just going to say this here, sales part of the transaction. Why don't we use accounts receivable? Because credit card sales clear the bank like that. And so as soon as they deposit them, they get their money. And so we treat it as cash. There's never much of a delay. In the same way that when you take the checks to the bank, you have that immediate, your account is immediately increased with a cash amount. Okay. So this entry should look a little bit similar to you. It should look like if this were like a back in chapter 5 when we had a sales discount or something like that here. But in this case, the merchant Crate and Barrel is saying, I probably wouldn't have made that sale if I hadn't accepted the credit card. So it's worth it to me to lose $30 on that sale and only get $970. But I still get to call it a sale for the 1,000. And then this is an expense that I'm reporting that I'm willing to accept. Okay. All right. So let's move on. Any questions on credit card sales? I think the bad news is, let's go back. From a merchant's point of view, what's better, credit cards or debit cards? And the answer is what? If you're a merchant, if you're a Crate and Barrel, would you rather have a debit card? Would you rather have a customer pay with a debit card or with a credit card?
Both.
Well, yeah, you just want the sales and preferably as often.
Probably debit because it doesn't have a service charge.
They do have a service charge, Cole, but the fees are really low with debit cards because if we don't have the money in our account, it bounces right there at the cash register almost immediately. And often they're less than 1% of sales. So in my example here, that's a little bit old. I didn't confirm these numbers. It's a couple of years old. I confirmed the credit card numbers, but I forgot to do the debit cards. These fees are pretty low, like $8 compared to on the previous slide, they were closer to 30. I'm sorry, 15 cents, $8.15 compared to $30 on the previous slide. Okay, so they typically have a flat fee of 0.8%. Okay, not 3%, 0.8%, and then usually a transaction fee of 15 cents, something like that. That was one example. Okay, so it's a lot better. They like debit cards a lot. The bad news about debit cards is if customers don't have the money in their accounts right now, they can't buy. And so that's always the attraction of credit cards, which is buy now and pay later. Okay, so any questions on that? Okay, we're going to move on unless you do. Oh, Helena, you had a question about let's back up. Why would, go all the way back here. Where did it go? You had a question. Oh, I can find it. Why would, okay. Helena's question was, why would the allowance for doubtful accounts go debit balance? That means that maybe you had a beginning balance of 20,000 credit, but remember, we're using that allowance account all year long to write off bad debts. And if we write off more bad debts than we had set aside in the credit balance, then we're going to go debit. And we have to fix it. We have to fix it right away. And so in this example that I gave you on Monday, we said, let's say right before you adjust and make that periodic estimate for bad debts, you have a debit balance here. So we say it's a debit balance. Oops, we wrote off more than we had in the account. And now we're going to update our allowance account. We use 10% of receivables, accounts receivables 30,000. If we're using the receivables method, we have to take into account the beginning balance in the allowance for bad debts. Okay. So the beginning balance in the allowance for bad debts was 2,000. Our goal is 3,000. How did we get the 3,000? 10% of receivables. And then we have to say, but that's our ending balance goal. To get there, we have to make an entry of 5,000 because we have to cover those write-offs that we made during the year when we didn't have enough money. So it happens when you're doing the actual write-offs. All right. So we have situations where a company has cash flow issues. They need their money and they need it really, really fast. And so what happens is they may sell to their customers on credit. Now, remember, business to business transactions are not typically made with a credit card. The business orders an item. The company sends them an invoice. We saw that with that Whitehall Robin aging schedule, and then the customer pays within 30 days or thereabouts. What if the company cannot wait 30 days for that cash? In that case, a lot of companies make the decision to use a factor. A factor is a company that buys another company's accounts receivable. They charge a fee for doing this, which is called a discount. And then they turn around and collect the full amount from the original customer. And typically, fees range from 1% to 3% of the receivables purchased. Okay, so let's look at the bottom of page 26. And this journal entry is going to look identical to the credit card journal entry. So let's see if you guys can do this. So let's start with who is the company and who is the factor. Who's the company?
Is it Greenbaum?
Greenbaum is the company, yeah, good. And the factor is Federal Factors, okay? Who is booking the journal entry?
Is it Greenbaum?
It is Greenbaum, correct. Okay, so see if you guys can come up with a journal entry here. Oh, you know, I said it was identical. That's not true. Instead of sales, you're going to use accounts receivable. The rest of it is the same. So Greenbaum has $600,000 as a debit balance in accounts receivable, and they're selling it to the factors. So they're going to credit accounts receivable for $600,000. What's the rest of this journal entry? Julie, correct. Right. Okay. So we're going to empty out accounts receivable. Okay. We're going to collect, Greenbaum's going to collect $588,000 from Federal Factors. And they're going to recognize this cost to the company of $12,000. Okay, I want to do something here. Let's see if I can pull it up really quick.
Can I just copy this down real quick? Sorry.
Sure. Can you still see it?
Yeah, I can see it right now.
Okay, yeah, copy it down. I'm gonna pull up a financial statement. Shoot, come on.
Okay.
Okay, good. All right.
Can you explain this one a little more? I'm kind of confused on, so they're selling their receivables.
It's weird. It's super weird. Hang on, I'm trying, let me just, hang on just a sec. I'm gonna bring up a 10K of a company that does this.
Kind of like a collection agency, though.
So let's say you have a balance sheet and you have, I don't know, cash of $30,000, accounts receivable of $600,000, inventory of $300,000, and other items on your balance sheet. And you're looking, and you've got to meet payroll in a few weeks. You've got to pay your employees in a few weeks, but you don't have the cash to do it. Sure, your customers are probably going to pay within the next 30 to 45 days, but you need cash now, okay? Companies' cash management is just such a big deal because they have to look at inventory and they have to look at their cash balance and they have to look at accounts receivable and they have to say, and they have to look at payroll and they have to say, when do we need money next? And so this company, and I made this fact up, this is not a true story for Greenbaum. This company says, we can't afford to wait 30 to 40 days to collect this $600,000. We have to sell it now. And so they're basically bringing in a third party who's saying, we're willing to wait, but it's going to cost you 2% of your accounts receivable, $12,000. And that'll pay our employees who are going to go out and do the manage accounts receivable.
That actually makes a lot of sense.
Does it make sense? And so companies do this all the time, okay? So I've been working a lot the last few weeks trying to pick companies for your projects. And by the way, we'll take a break in a second. And so I had to keep rejecting companies because they did not have accounts receivable, okay? And because we're studying accounts receivable, it's part of the project. So this is a company I rejected, even though one of you wanted this company. They don't have accounts receivable. It's Foot Locker. They have cash and they go right next to inventories, okay? So they clearly have done something. They're not choosing. Now, another way to look at this is not necessarily that the company is failing or struggling or at risk. Another way to look at this is we don't want to manage our accounts receivable. It's a lot of work. We don't want to do it. We'll sell it to a factor. They're good at collections. We're not. Let's just it's like outsourcing something. We don't want to do it. And so Foot Locker doesn't have accounts receivable. Okay, they don't have it. And so there you are with a company that I can't use for a project, but it's sort of an interesting observation. And the reason I say I can't use for a project is I want you guys to calculate things like accounts receivable turnover, how many days to collect. I want you to have the full experience with your companies of all these numbers. And so I was able to do Nike. Nike has accounts receivable, but I had to match it up with a different company. All right. Okay, so let us go back to this. And the last topic we're going to look at is notes receivable. Okay, so let's take a 10-minute break. Let's come back at 11:33 and we'll start in on notes receivable. And if anybody has any questions, feel free to ask.
I have a question.
Shoot.
So when we were discussing the percent of sales method, why don't you subtract the like on page 22, why don't you subtract the 62? Wait, hold on one second.
The 17,000.
like, why don't you subtract the 17,000 from the 62,500 and make the ending balance 62,500?
Because the percent of sales method doesn't care, because it only cares about matching that 2.5% to the sales. So for example, imagine you have 3 years of data, like we do for our statements, right? And I'm not talking about what you see on the SEC. You see like summary data on the SEC. But internally, the company is saying, let's look at 3 years of income statement data. And they're going down through their expenses and they're saying, oh, payroll is running about 40% of sales. Let's say we're a IT company. Payroll's 40% of sales. 3 years ago, it was 40%. Our sales have gone up, still about 40% and so forth. What about our bad debt expense? Well, 3 years ago, it was 2.5%. Now it's 2.5%. Now it's 2.5%. And so the goal of the percent of net credit sales method is that you're matching to sales. So the expense doesn't go all over the place because of taking that beginning balance. Now, switch over to the balance sheet. The balance sheet is saying we want a percent of what's in accounts receivable so that those dollar amounts are best matched. We've gone invoice by invoice by invoice, and we're matching that up. And we only need this amount of dollars to get to that match. We've applied the percent, we only need this many dollars, and we've done the analysis and we're good. So they're just two totally different methods. One's a balance sheet focus, one's an income statement focus. And it is really like LIFO and FIFO. You're going to get two different answers. Percent of sales is a lot easier, but you have to be careful that you're using the right data. And you also have to periodically go back and do that review of accounts receivable. So it's a lot simpler. Just read your problem so you know which one you're doing. So,
Okay, that makes sense.
okay,
Thank you.
that. Anybody else have a question I can answer on the break? Okay, all right.